Hello, hello, hello. Back at it again. Back at it again. Hello. Per usual, gonna go ahead and get this Instagram popping. What's popping? Brand new with just hopped in. Mm, mm. Hello, everyone. Happy Financially Lit Tuesday. Give me 1 second. Momento, whatever. Oh my gosh. I ruined that like pretty bad. Um, there we go. All right. All right. Hello, hello, hello. Okay. Okay. Got it. Okay. Yeah. Oh, that's kind of cricket. Ugh. Okay. Hello, everyone. Happy Financially Lit Tuesday. Once again, back at it again every Tuesday at 6 p.m. We are financially lit. Of course, the whole day we lit, because every day we lit, but especially on Tuesdays. So today I'm going to be going over the wealth hierarchy, and it's not really like out there, but it's something through my financial journey that, and with Grand Rev, I was like, you know what? Just like Maslow's hierarchy of needs, there needs to be a wealth hierarchy of as like steps, levels on building that wealth pyramid that starting with your foundation to the peak. What does that look like? How do we get there? So I'm going to be going over that today. Other thing I'm going to be going over is a little bit about the stimulus update, just to kind of because I did say last week that I was going to kind of give an update as to what happened, what's going on with that. So I'm definitely going to go over it today. Hey, Marcia, hello, Nestle, Quick, and Mr. G Cuts. Hello, everyone. Um, so I'm gonna make sure I go over that with you all today, and then of course, like always, throw in some financial tips so that we can wealth up together, right? Oh man, I brought my water today, y'all, cause I know I'll be thirsty. Okay, Sabrina. Oh, it's you. Hey, girl. Because I'm like, how do I say that? Ooh. Um, but yeah. Uh, yes, back to what I was saying. So to start us off, really, I really want to start with the basics of like, of course, achieving wealth is possible. It is possible for anyone and everyone. You just have to have that right state of mind. That state of mind that's not, oh my gosh, the rich are stingy, the rich are bad, because that's what's holding us back from achieving true wealth. So really going into this with the right state of mind is absolutely important. So before we even get into the hierarchy, the affirmations, that right state of mind, putting yourself in a position of being ready to receive the abundance is absolutely necessary. So yes, let's get that in that feel, right? So to start us off and take notes, because we are going in today. Like this is a crash course. If you have been to one of my seminars, if you haven't, I've been. I've gone over this in a few of my seminars. Like, so this is like heavy note taking. Get ready. Right. So we're going to, and of course, throughout this, if you have any questions, don't be afraid to ask. If you have personal questions outside of this, book a consultation on the website or the link that's attached to the video for Facebook or the link on the bio for Instagram. To start us off, we need that psychological need. So just like Maslow's hierarchy of need, we start with that psychological sense. So making sure that we are affirming wealth and abundance in our life. So proclaiming health and wealth, making sure like your financial future is brighter than your past. That you're always in control of your spending, no matter what. The choices and is yours, and you are in complete control. Your money doesn't control you, you control it, right? So making sure we're putting the right affirmations in our minds. Grand Rev, we have affirmation cards as well. If you need an affirmation card, definitely grab one, let us know. we'll send it out. Um, the next is safety, because we know when we're building that foundation, we have to make sure that we're secure. A lot of the times, people come to me and they're like, "Yeah, I got a great job. I'm doing, I'm bringing in some money. I'm ready to invest." But we have to make sure that we and put into our safety net first. We have to make sure our safety net is secure. That if anything happens to us, that we have something to fall back on. That we're not depleting our investment account, because investment accounts need time to grow. If we're depleting that and we're not allowing that time for the investment to grow, then it defeats the purpose of having an investment account. So really making sure that where we're doing the steps in order, and we're not just jumping just because we want to start investing, or like we're stacking up all this money in our savings, but we have a bunch of debt, right? So, all right. So we got our affirmations out the way. We're proclaiming health and wealth in our life. Our safety, first things first, is to understand interest. So you have to understand how interest works, because even in your safety net, interest is something that's going to play a big part in how you're saving your money. Because having a saving account is cool and all for like a rainy day. Maybe you need to grab $500 really quick because your tires, you need a new set of tires, or something's wrong with your car, or a quick emergency, right? So that's cool, but we need to understand what our money's earning as far as the interest goes. So the first time, there are two main types of interest. One is simple interest, and the other is compound interest. So how compound interest really works is when the money that we invest is the interest is only calculated based on the money that was initially invested. So say I invested $100 and my interest rate is 10%. Every year I will be gaining 10% off of that $100, not 10% off of 110, 10% off of 100, whatever it will be the next year after that. So it will always be what it was that first year, that first initial investment. The other is your compound interest. Well, your compound interest is mainly when institutions are talking about APRs, things like that. That's mainly what they're talking about. That is your compound interest in a sense. So if you ever want to like, what? I don't really know what that is. Okay, whatever. That's what it is, right? So your compound interest. Say you're investing $1,000 and at a 10% interest rate. So the first year you have $1,010. I mean $1,100, because the interest is gaining off of that initial year, right? Because all you had in there was $1,000. But now the second year, it's the interest is going to be accumulated off of $1,100. So 10% of $1,100, which is going to bring you to that I already got the calculations written down, y'all. A total of $210, because the second year is 110. So now you've accumulated $210 in interest over 2 years, versus with the compound interest, it was $200. So you really want to understand the difference. Another thing I've taught is, if you heard my wealth up events, seminars, or even lives, I've talked about the rule of 72. So with the rule of 72, it's like a quick math. It's not going to give you an exact, but it will kind of give you a quick idea of what the interest would be over time, or the debt would be over time. So say you put $1,000 away at 10% interest rate. You divide 72 by 10, and it's going to tell you how many years it's going to take that money to double. So if the interest rate was 10, it's going to take 7.2 years to double. So working that working that math that way. So that is really the basis of wealth in general. So you have to understand how interests work. Like, and that's how you're gonna have your money working for you when you're sleeping, when you're moving out and about. Your money is gonna be in the background working for you, because you understand interest and how your money is earning on multiplying without you having to do much, because you made that initial investment or that continuous investment at a great interest rate. Again, like I said, as I go through this, if you have any questions, please go ahead and comment. Comment, hey, let me know that you're here in live with me. Uh, so the other part, so back to our step two in our wealth hierarchy. Our wealth hierarchy, which is step two, is our safety. We need to make sure that we're protected. So our life and health protection is for ourselves and our family is absolutely important, right? Because if anything happens to us, say we are running a business, for my business owners out there, and something happens to you where you can't work for a week, what happens to your business, right? What happens to your stream of income? If you're the breadwinner of your family, or you're on your own and you're working to and hey Autumn, and you're working to pay for your bills and things like that, and something happens to you and you're out of work, what happens? Like, do you hey mom, could I borrow $1,000 to hold me over? Hey Don, you have to have a plan, right? And that's what this does. So having the right life and health protection for yourself and your family. So when it comes to life insurance, I will go and through the courses of these weeks, I will break down life insurance. It doesn't have to be complicated. It really can be something that's understandable for anybody and everybody, but it just takes you a little time and you wanting to learn about it, right? So with life insurance, um, you have your three main types, right? You have term, whole, and you have your universal life, which is kind of like a hybrid. Right. So with term insurance is usually for a certain period of time. So it's usually cheaper. So if somebody says, "Oh, I have a $500,000 death benefit and I pay $30 a month," I automatically know they have term insurance without them telling me anything else. Right? Because generally term insurance is a lot cheaper for a high death benefit, which term insurance is not a bad thing. It does expire after a certain amount of time, but it's also something that you just like that's you don't just want to have term in a sense. So you want to have something that's also growing in interest, that's also safe. So term is great. Have that, especially if you have a convertible term, because a convertible term insurance. Say you have a convertible term for, hey Arthur, you have a convertible term insurance for $500,000, and you don't have enough money to convert it into something that's permanent, like a whole life or universal life. You can actually convert it little by little. So say I have enough to convert 100,000 of it into something permanent. Okay, and then maybe 2 years later, I'm making more money and I can convert the rest of it into something that's permanent. So it's something that we really want to look at because you don't have to requalify a lot of the times for you don't have to requalify for convertible term insurances. So if you know, like, a lot of the times, right? So if you know, like, hey, I'm gonna get $1 million term insurance, convertible term, and then over time I'm gonna convert it into a IUL or a whole life, and I'll get into those pretty soon. So and, you can do that, and that's something that's earning interest. So your whole life and your universal life, those are earning interest, and it differentiate the amount of interest rate differentiates as far as like who you're insured by and also what type of policy that you have as well. So look into that. Terms generally can be 5 years, 10 years, 15 years, 20 years. It's like I said, it's not bad. It's something good. It's cheap, especially if you're young and maybe you don't have that much money to buy into life insurance right now. It's okay. You can get a term insurance and then pay $25, $30 a month and make it a convertible term. And then you can convert it into something that's more permanent over time, that's earning interest. The other type is, and then term can also be 30 years as well. But you have to know if you already have insurance out there, please like look at your policy and see how long your term insurance is going to be active for. Because I run into a lot of people and they're like, yeah, I have insurance. And then when it's time to use it, they're like, oh, shoot, it expired 5 years ago. Yeah, you don't want to be in that position. It's very hard, tough position to be in. Um, all right. The other is whole life. So whole life is also known as straight life, traditional life, ordinary, and it's usually like the one that gets thrown around. It's a lot of people know about it. It's very familiar. But with whole life, it's more money than your term because it covers generally for the whole life of the person, individual. Now, not to say that whole life can't expire before you pass, but generally it's so drawn out that it covers for your whole life. So say it'll cover until you're like 101. God forbid you become 102, but I mean, not God forbid, but it would be great, cool. But and then your insurance, your whole life goes lapse, and then it's like expires, and it's like, oh shoot, we didn't actually expect it to happen. But generally, it covers your whole life. Um, but there's also a fixed death benefit, fixed premium amount. So say you're like, hey, I'm gonna pay $500 every month for it, and the death benefit is $500,000. Also, there's a cash value savings portion. So usually it's about maybe 3 to 4% around there. Um, and so that cash value can also go towards your cost of being insured. So like over time, it's more expensive for the company to insure you. So it also goes into that as well. And then the cash value can also be accumulated as a tax deferred on a tax deferred basis. So when you get into taxes and all that and life insurance, it's a whole nother ball game. uh, but we'll talk about that in other lives. The other is your universal life. So a universal life, it's similar to whole life because it generally covers over the entire lifespan. But it's a lot more flexible because you can change the premium amount. Meaning, if you start at um, $100,000, you want to go to 200, you can. You can increase it as long as you're making sure that you're covering the cost of assuring you over time. So the cost to insure you over time does go up as you age, as generally as you age. That's how they put it in their little chart goodness thing. But yes. So, and then it also has that stock component with Universal Life. So they do have generally a floor and a ceiling. So with the floor, if the stock market were to completely crash, it has a safety net. So with certain companies, it's like 0.75%, maybe 1%, maybe 0.5%. You really just got to see what your percentage is as far as what company you're going with to be insured with. So, with that being said, you do also have that ceiling. So, say if the stock market were to like skyrocket, like booming at 20%, oh, we lit. Now, you're maybe capped at 15%, but you're growing interest on that cash value at 15%, which now you have safety, you have that interest growing, and you have interest growing, safety, death benefit, and you can do the long-term care. So the long-term care rider is something that ride alongs with the policy. So if anything will happen to you, if you become disabled or ill or something or any of those, then you can actually the policy can actually pay you out 2% of your death benefit. So I mean, I could go on for a while with life insurance, but I just kind of wanted to give a little bit as far as so you can get a good idea for step two of your wealth hierarchy. So making sure that you have the right health and life insurance. Adrian, so for whole life, there's no stock market safety net? No. So for whole life, if uh you're not gaining, it's just kind of it's fluctuating at whatever it is at that time. So some whole lives are connected to like come so like New York Life, they you're buying into New York Life. It's a mutual fund in a sense. So it's not going into the market. But you also have like other companies that they put it into something else. Their whole life policies are tied into something else, not the actual company itself, like New York Life. But yeah, Universal Life has that floor and ceiling component. Hey, Brianna. Um, hey, Love and Self First for Life. I love these names. Um, Thank you, Adrian, for that question. All right. The other thing is health insurance. Of course, health insurance could be very pricey, but it can be very beneficial. Like anything, um, it's like and when you're paying it, it's like, oh my gosh, I gotta pay health insurance. But if something were to happen and you're stuck with that huge medical bill, like it becomes very beneficial, right? So with health insurance, you have three main types. You have your health maintenance organization, which is your HMO. You have your preferred provider organization, which is your PPO. And then you have your high deductible health plan, which is the HDHP. Now, of course, like we do have those the plans, the tax benefit plans, as far as your health account goes, putting money away that's going towards health costs that you can have that's tax deductible. But outside of that, making sure you have the right insurance. So with the HMO, your health maintenance organization plan, there's not much paperwork needed with that. But you do need a referral from your primary doctor in order to see a specialist. And so there's a lot less freedom, but it is cheaper. Then you have your preferred provider organization, which is your PPO, which is a network of a bunch of different doctors and hospitals and things that can assist you. And you don't need a referral from your specialist. So you can choose whoever's on the list and then go, and that's all you got to do, right? But it is usually a little more expensive than your HMO. And then you have your high deductible health plan, which it says high deductible health plan. It's gonna be a little penny, but generally it covers a lot more. As far as your deductibles go, so with that health plan, it has a deductible of like 1,400 for an individual, 2,800 for a family. And then so the premiums are usually lower, but you have a high deductible. Of course, it's a little high. But and then they can go up to like as far as like $3,000. So that is something to look into, but of course, making sure that you have the proper life and health insurance, so that you're well protected. So that's step two of our wealth hierarchy. Step one was the psychological needs and necessities, those affirmations. And then we have that safety, which is your life and health protection. Next is our community, because we can't do it all on our own, right? We need a community, we need a sense of accountability. Um, God did not put us in this world to do life alone. And nor can we. We're social beings, and we need to interact. And the people around us help keep us accountable. So really making sure that we have the right people, the right team in our life to make sure that we're accomplishing our wealth goals. So whether it's our family and friends, whether it's finding that right accountant, whether it's finding the right insurance broker, whether it's finding that right tax agent, whatever the case may be, having that team that's gonna make sure that you get to your wealth goal. So just know and understand that you can't do it alone, right? And it's okay, but making sure that you have the right team to get you to where you need to go is is the goal. So that's community. Then we have our esteem needs. So our esteem needs is our planning and implementation phase. So we got our psychological needs, we got our safety net, all right, we got our team, we're ready to go. Now we're about to plan, we're gonna plan it out and we're gonna start implementing our goals. So we met with our wealth coach. She said that you have to do this, that, and the third. Your credit repair woman said that you have to do this, that. All right, we're in here, we're doing it. So that's that stage that's also critical as well, because that's that stage that's going to make or break you. That's your debt management. So you got your protection, you're going to do your debt management, get your debt under control. Debt free, I say debt free all the time, but I don't mean operate with zero debt. Just get your debt and very managed, like manageable debt, where yes, you're using debt, but only as leverage, not because you need it. So don't don't let debt control you. Have it under control. Make sure you reduce your liabilities. Anything that's at a high interest rate, let it go. You don't need that debt in your life. I had to let a couple of credit cards go because they was playing games. So really make sure that I'm at that stage, LOL, but I'm trying to invest. See, and that's completely fine. So yes, so you're at that stage where you're like, hey, like I'm trying to put my money in the right place. I'm trying to also manage my debt, which is fine. So investing early is necessary as well. So I would recommend, if you don't have that life insurance, my car. Oh yeah, car debt. Yeah, car debt definitely got to go, because car debt is one of those debts that you're really investing into something that that's not really going to be fruitful. It's cool and it's nice and it gets you point A to point B. And no lender or anybody likes to see car debt, automotive debt, because it's really just sucking. You're paying out interest to these institutions. But yes, outside of car debt and managing your debt, really, I would recommend definitely making sure that your money's in something that's safe, like the IUL, the Universal Life Insurance. So maybe looking into something like that. So yes, you're investing, and maybe you're not ready to invest into and say like real estate or something like a large investment. But at least you have that safety net, which is necessary. And then you can start investing into like other things, once you have that safety net, and then get your debt under control. Go ahead and pay that stuff off, and leave your emergency fund manageable, but pay off your debt as soon as possible. Those unmanageable debts, especially the car debt. What is unusual and customary in the medical payments? There is really like there's not really a usual or a customary, because everybody is so different as far as the medical bills and things go, because people have different health needs. I mean, from somebody that's dealing with cancer to somebody that maybe have diabetes to somebody that's completely healthy. Somebody that's completely healthy could be a premium of $150 a month, versus somebody else could be 550, $600, sometimes thousands of dollars. So it fluctuates. It really depends. Um, yeah, there's it's really when it comes to health payments and insurance and things like that, it fluctuates so much. Even life insurance, it fluctuates. You rarely will find anybody that's making the same amount of payments unless it's something like term and they're completely healthy. Yeah, because everybody has different family backgrounds and they all take that into account, the hereditary genes, things like that. um, but yes. So yes, debt management, reduce your liabilities. Get out of debt. Generally, you can use debt as leverage, like I said, but let all the debts that's not really gaining you any assets. So we wanna have debt that's actually bringing in money. So if we're gonna say that, hey, I'm gonna go ahead and take out or get into this debt or take out a loan, make sure that on the other side there is something that's producing income from that debt. If the debt is not producing income, then it's really a debt that you don't need, and it's a debt that's putting you in a hole. So really making sure that we have manageable debt in that sense, that the debt is also attached to an asset. Uh, yes. Emergency fund, of course, emergency funds are necessary, making sure that we have those 3 to 6 months of your income. Now, I say your income, I know a lot of people say like, should it be income or expenses? Uh, oh, hey, Linda. Hey, Wadner. I'm looking at these messages super late, my bad. Uh, yeah. Um, so Okay, okay. But yeah, I was reading. Hey, Autumn, thank you. Um, Okay, emergency fund. So 3 to 6 months of your income. Why do I say income versus your expenses? Because with your income, you're used to a way of life. So, and I deal a lot with that with budget planning, doing my budget analysis with my clients or financial assessments, because my client is already used to a way of life. If I say you have to cut $1,000 from your budget and I do all this, they're not gonna change their habits because they're gonna feel like it's like a crash diet in a sense. Crash diets don't work because as soon as you go back to eating the way you were eating before, you're gaining all that weight back. Same thing with financial needs. And that's why when I say I'm a holistic wealth accountant, that's what that encompasses. It's saying, hey, like, if I'm not gonna cut all your, I'm not gonna say, I'm not gonna give you a magic weight loss pill or a magic get rich pill for your finances or a magic fix it all pill. It's gonna take time. So it's gonna be something that we have to learn and move and control your habits and grow and put in new habits, better habits, financial habits, because it's not gonna happen overnight. So with same thing as like building that emergency fund of 3 months of your income, you're already used to living off of $50,000. You're used to living off $100,000. Now, if I say your expenses are $3,000 a month, but you make $5,000 a month, and you're like, yeah, I got $3,000 in there, but you're used to living off of 5,000. Now, when you no longer have that $5,000 coming in, like stuff get real. Right, because now you have to shift your way of living. Now you feel like you're almost like uh trying to find like scraps of food and to eat. Oh, I can never go out to eat because all I have was $3,000 of my expenses in my account. All I can cover is my expenses. I can't even go enjoy my life. So that's why I say make sure they have 3 to 6 months of your income, and so that you can pay for any unforeseen accidents, changes in your job, maybe your business, like with this COVID stuff, or any repairs that you have to make. So make sure that it's 3 to 6 months of your income, not expenses. Um, and then we get into investment. So you have your protection, debt managed, your debt. Your debt managed, and then you're like, oh, I got my emergency fund is popping. I'm ready to invest now. Oh, I got that money saved up. And when it comes to also saving, you should have different savings. So all your savings should not be in one account. Definitely make sure you have multiple savings account. One should be saving for your rainy day. One should be saving for things that you want to do in your life, maybe a vacation you want to go on. And the other should be for saving for risk, which is investment saving. So investment saving is a whole nother account, and you're like, if that move, God forbid that money goes away. I mean, gets lost. But if that money does, if you lose all of it, then you won't be completely hurt and burned and out of a house or whatever the case may be. So make sure that you have those different saving accounts. You have that risk money account so that you can actually invest in, and that's going to be your long-term investment, your generational wealth investing. Your, you know what? I say that $10,000. I say that $20,000. I'm going to go buy that $50,000 house and rent it out or whatever you want to do. But you already know that that's your investment account. So make sure that you're putting money into that investment account from time to time, as well as the other savings accounts, along with meeting your expenses and all that good stuff. So that's our stage 4, and our last stage is 5, which is our self actualization stage, and that's achieving ultimate wealth, our ultimate healthy and wealthy life. Our lifestyle. So of course, we're gonna continue to sustain. I need a review of my wealth hierarchy. Yeah, yeah. So I'll run through them like very quickly, and I go through them like I go through it in like almost all my wealth seminars. But this is my first live on the hierarchy itself. Um, But yeah, I'll run through them really quickly once I'm done. So your self actualization stage is you're continuing to maintain the other stages, just like you're in your Maslow's hierarchy of needs. You're sustaining those other four elements, but you're also living your healthy, wealthy life, making sure that you have your accountability team, your coaches, um, all that, like all that good stuff. Yes, Arthur, your health is a huge component, and it really, like, last year was probably like a huge transformation for me just in my health, and taking ownership of that and making sure that I'm teaching wealth. I'm teaching financial stability. But your health is really, like, because you can't have one without the other. You can't say that I'm going to build this wealth, but you're too sick to enjoy it. You really want to be make sure that you're concentrating on your health as well as growing your wealth at the same time. You're eating those foods that are are non-acidic to your body. That's really feeding your soul, and not your cravings per se. But yeah, make sure that you're concentrating on our health. It's absolutely important to make sure that we're doing that so that we can actually enjoy that wealth that we're creating, enjoy the lifestyle that we're creating for ourselves, our family. It's beyond important. And I also made sure that I tied that component into my business as well last year. And then moving forward and making sure that we have that holistic point of view as far as maintaining our wealth, because yes, our health is a very important component of it. Um, yes. So those 5 steps from the bottom up is our psychological, which is our affirmations, making sure we're putting those good thoughts in our heads that wealth and abundance is just coming into our lives. Yes, it's all that good stuff. Your future is brighter than your past. That you're in complete control of your spending. Your money does not control you. Um, and then we have that safety. Step 2 is the safety, making sure we have the right life and health protection for ourselves and our family. They both are important. So many of us miss the life and health insurance protection component, and it's very critical that we have that. And it's one of the biggest, the easier ways of accumulating generational wealth as well. Community, making sure we have the right team, we have our family, our friends rooting us on, all that good stuff, our coaches, our accountants. Yes. Esteem needs is our planning and implementation phase. So that is when we get into work, okay? So heavy work, making sure we're doing the work that our coaches, um, our professionals guided us on, and making sure that we get that work done. And then making sure that we're planning, okay? Because if you fail to plan, then you plan to fail. That's what it is. And then 5 is our self actualization stage, which is achieving ultimate health, a healthy and wealthy lifestyle. So maintaining that and maintaining all those 4 steps as well. That's underneath. I did go over a lot of information from health insurance to life insurance to interest on this live. If you missed any part of it, I recommend definitely going back through it because I did put a lot of information through it on this live. And of course, the video will be available on the Sipping Wealth YouTube channel. Um, I'm gonna do better as far as posting it right after my lives, so that you all have it available as well. And of course, the replay is available on Instagram and Facebook as well. But yes, thank you, you all. Let me make sure I don't have any questions that I'm neglecting. Let me know if y'all have any questions as well. I try to not make these too long, um, so that the replays aren't like, oh my gosh, I have to watch an hour. Um, but looks like I have a question, but I'm not able to see it for some reason. Facebook does what it wants, yo. I swear. I wish the Facebook stream was a lot easier than like the Instagram. Hey, Rachel. Okay. Uh, Okay. All right. Yeah. Then that's it, y'all. Another financially lit Tuesday. What is the disadvantage? Um, when is it a disadvantage to take unemployment? That's a great question. Really, I would say if you are unemployed, you can go ahead and take unemployment. It doesn't have a negative uh, kickback on you. And now, if you are a business owner and say like you do pay reemployment tax, of course you do have to pay that. The reemployment insurance and things like that. So it does kind of hit you as an employer if you're the employer and you have people or even yourself on unemployment. But if you're, outside of an organization and you're taking unemployment, there's really not a big sense other than it's a hit in income versus you finding another like job or something to go to that's going to give you a lot more income than unemployment. Um, Meaning, what is the minimal amount one should be making so it doesn't work against you? Oh, oh, excuse me, my phone is dying. So I would say the minimal amount so it doesn't work against you. Oh, that's a great question. I forget the amount. And literally I just helped somebody with it not too long ago. I believe it was like 12,000 or so. 12 or 14,000. If you're above that amount, then uh they cut the amount that you're making on unemployment or you're no longer eligible for it. Um, so anything other about $12,000, anything under it, you should be fine. And then over it is like, oh, you're making too much money for unemployment. You're good. Um, Basically, which is their idea of what the cost of living should be. Um, so if you're above what the standard cost of living, then they're like, oh, you could sustain yourself. Um, yes. If you have the opportunity to, I wouldn't say stay on unemployment for long. I know it's kind of like easy to say, hey, I'm going to take this break off and kind of like go on unemployment, but it is a big hit in income, a big income hit. If you feel like, yeah, I can go on unemployment and I'm focusing on building a business or something that's going to bring in more income, then sure. But if it's something that's stunting your growth in a sense, then um, I wouldn't utilize it because I see it a lot where people just rock out unemployment and that's it. Any other questions? All right. Well, I'll be back next Tuesday at 6 o'clock for Financially Lit Tuesday. The last thing I do want to leave off on is the stimulus update. They didn't reach a decision on Friday, August the 7th. So they will have to push it out until September. So in September, uh, what was that date? Um, in September, they're gonna go ahead and give a date a decision, a final decision as far as when the stimulus payout is going to go ahead and take it into effect. Um, it's about the first week of September. I had it written down, but yes, and then we'll move from there and see what the government is going to do as far as the stimulus update. I was trying to written it down. I lost the page. But all right, y'all. Thank you for joining me. Until next time, I'll see y'all next Tuesday. Have a good night.